Welcome to this step-by-step guide on understanding and applying deferred tax accounting as per Ind AS 12. The foundation of deferred tax lies in temporary differences. These arise when the carrying amount of an asset or liability in your financial statements differs from its tax base according to tax laws. These differences can be taxable, leading to a deferred tax liability, or deductible, resulting in a deferred tax asset. A deferred tax liability is recognized for all taxable temporary differences. However, a deferred tax asset is recognized only when it is probable that sufficient future taxable profits will be available against which the deductible temporary difference can be utilized. To measure deferred tax, multiply the temporary difference by the tax rate that is expected to apply when the asset is realized or the liability is settled. Importantly, this should be the tax rate enacted or substantively enacted by the end of the reporting period, and deferred tax amounts are not discounted. When recognizing a deferred tax liability, the journal entry typically involves a debit to income tax expense and a credit to deferred tax liability. Conversely, recognizing a deferred tax asset involves a debit to deferred tax asset and a credit to income tax expense unless the deferred tax asset relates to items recognized outside of profit or loss, such as in other comprehensive income. At each reporting date, it's crucial to reassess deferred tax balances. This involves considering any changes in tax rates, evaluating the recoverability of deferred tax assets, and accounting for any movements in the underlying temporary differences. In the balance sheet, deferred tax assets and deferred tax liabilities are generally presented separately. Netting off is only permitted when specific criteria are met, such as when they relate to income taxes levied by the same taxation authority, and the entity has a legally enforceable right to set off current tax assets against current tax liabilities. Ind AS 12 also mandates specific disclosures in the financial statements. These include the components of tax expense, a reconciliation between accounting profit and taxable profit, information about unused tax losses and credits, including their expiry dates, and a movement schedule showing changes in deferred tax assets and liabilities during the period. Let's illustrate with a simple example. If a company has a taxable temporary difference of 20,000 rupees and a deductible temporary difference of 5,000 rupees, and the applicable tax rate is 30%, this would result in a deferred tax liability of 6,000 rupees and a deferred tax asset of 1,500 rupees. In summary, the process of deferred tax accounting involves identifying temporary differences, classifying them as taxable or deductible, measuring the deferred tax using the applicable tax rate, recording the necessary accounting entries, and finally ensuring proper presentation and disclosure in the financial statements. This concludes our step-by-step guide to deferred tax accounting under Ind AS 12. If you're looking for a ready-to-use Excel template to simplify these calculations, please visit the link on screen or contact us.